Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast on Monday, the 2nd of February, with me, Bernadette, and Anderko. On the show today, my colleague Bopp will be bringing us the latest markets news, and there's plenty of it. And then our Chief Economist is going to unravel some of the impact of Kevin Warsh's appointment as the new Fed chair. And of course, we'll be taking a look at things from a technical perspective with our head of technical analysis, Mensur Pocinci. So let's get started with the news roundup. Good morning, Jan, and thanks for joining me here today.
Good morning, Bernadette.
Let's jump right into the precious metals market where, gold and silver experienced what can only be described as an earthquake on Friday.
Yeah, the moves were dramatic actually, and highly volatile. Gold dropped almost 10% on Friday, falling below, well below $5,000, and silver tumbled below 100, down almost 30%, 30. For gold, that was its biggest one-day decline since 2013. For silver, it is the largest absolute drop in history and the biggest percentage decline since 1980. And another wave of selling has emerged this morning, with gold down another 7% and silver 10% lower. No, 12% lower. I probably have to update the statistic. Gold is now trading below $4,500 silver. It's $73 last time I checked. That was like 60 seconds ago. You have to check your screens like every minute. That's how volatile the moves are this morning. The Chicago Mercantile Exchange has sharply raised gold and silver margins to 8% and 15% respectively. Chinese authorities also took measures to curb activity in the space. Interestingly, most analysts do not expect that this is the end of the trend. They see this rather as a healthy correction, if you can call such a sell-off healthy.
All right then, but perhaps you could fill in our listeners on the reason behind those dramatic moves, Jan.
Well, as usual, it's a combination of things. But let's say the spark behind it was news that the Trump administration was preparing to nominate Kevin Warsh as the next Fed chair, something that was confirmed later on Friday.
And Warsh is a familiar name, right?
Absolutely, Bernadette. He became the youngest Fed governor back in 2006 at just 35 years old. During the financial crisis, he played a behind-the-scenes role in stabilizing Wall Street, and he's been vocal in the past about inflation risks. In 2021, he warned that the Fed was fueling future inflation by maintaining large-scale asset purchases. That stance shapes how markets see him today.
So traders worry he might be more hawkish than other candidates?
At the margin, maybe. I mean, he has more recently echoed calls for lower borrowing costs, but his past criticism of the Fed's balance sheet and his focus on inflation mean markets aren't viewing him as dovish or Trump's puppet, to be frank. And that's a big change in market expectations. Investors are reassessing valuations and recalibrating expectations for monetary policy under a potential Warsh-led Fed. And in markets, I mean, the dollar reacted quickly. The dollar index gained 0.7%, pushing the euro back below the 119 level.
Yeah, but the bond market didn't really participate in the drama, did it? Yields were basically unchanged and equities were rather mixed.
Yeah, US stocks finished low on Friday. European stocks rebounded. They were supported by better than expected GDP growth and strong earnings. Adidas and CaixaBank were among the standout performers on strong revenues and profit growth. So most sectors in Europe ended the session in green, except materials, of course, which were hit hard by the metal sell-off. But looking at the screens this morning, the slump in gold and silver is really having a domino effect on the rest of the market. Global equities are down 0.5%. South Korea's Kospi, a bellwether for the AI sector, trades more than 6% lower. In China, the onshore CSI 300 is down 2.3%. Hang Seng, 3.3% lower. And Nasdaq futures also point to a weak opening later today, down 1.7%.
Okay, so it's going to be another volatile session, it seems. And of course, we've got the earnings season in full swing.
Yeah, very much so. I mean, today we get results from Intesa Sanpaolo, Palantir and Disney. And the rest of the week is also packed. AMD, Alphabet, Eli Lilly, Novo Nordisk, Amazon, just to name a few. Analysts will definitely be busy. Other than that, the coming week will revolve around a dense run of US macro releases, with the January jobs report set to dominate attention on Friday. Central banks of course, will remain a major theme as well. The ECB and the Bank of England both will meet on Thursday.
Okay, well, it sounds like markets are entering February with nerves on edge.
I would say that's a fair summary. Lots to watch, plenty to digest.
Well, thank you very much for bringing us the news highlights today, Jan.
Well, thank you for having me.
Okay, so Jan's told us a little bit about the reaction, but let's find out some more about what caused it with our chief economist. Good morning to you, David.
Good morning, Bernadette.
President Trump announced his nomination for the new Fed chair on Friday. Jan's told us about the reaction. I've been reading over the weekend about the man who might bring about regime change at the US Federal Reserve. What's your take on this appointment?
Well, the changes are there, but I think in terms of probably the big picture, when we talking about Kevin Warsh, is that he seems to be a rather pragmatic guy in setting interest rates. And second, and that's probably even more important, he brings this like hawkish attitude or aura with him, which is then pretty helpful that in the case, really, he wants to go for lower interest rates. He's far away to be suspected that he is a Trump's puppet or does something the president wants. So with this standing he has already, like with the hawkish standing, this enables him to be really on the pragmatic side and even go then for lower interest rates and be not really in this camp saying he does that only because the presidents want it. In terms of like structural changes, yes, there's lots of talk about how the Fed will manage the plenty liquidity. They have like the ample liquidity regime they have been operating with. And there definitely, there's the risk more not to the economy, but much more to financial markets, how they can digest that. Financial markets are like liquidity, in particularly ample liquidity. And any changes in that in terms of like tighter liquidity conditions by the Fed, that might be a risk. And then also a structural change, how the Fed has maintained basically or managed financial markets in their liquidity role, not so much on the interest rate side.
All right, then. So what should we be expecting from the new Fed chair when he takes over in May then?
Well, probably in May, not much. So the debate, which is in the FOMC, this will continue. Is the economy or in particularly the labor market soft enough to allow further interest rate cuts, which is also the political will? Is inflation coming down? So these topics will not change with the new chair. And there will be also the decision making in the FOMC will be done by a majority. Kevin Warsh will have also only one vote. So what to expect? The Fed will most likely continue to set their interest rate policy according to economic data. And there, when it comes to our assessment, we're looking for softer inflation until May, and probably even to some further labor market weakness. So we think it's right to bet here on slightly lower interest rates going forward. If this happens only in May or in the meetings before, this has to be seen. It depends very much then on the economic data income.
Okay, well, whilst I have you here, David, we've got both the Bank of England and the ECB meeting this week, as Jan said. Is there anything we should be watching out for there?
Well, there is less urgency to act. Probably for the Bank of England, that's of course the big discussion. Is time right to continue cutting rates? We don't think so that this is happening this week. For the ECB, pretty much every expectations are that rates stay where they are. And this is not only the case in this week at this week's meeting, but also in the forthcoming meetings. The ECB has reached a position where inflation is well behaved, 2%, where growth is, some comeback there, but not great. And that means monetary policy remains at a good place. So for both central banks, we don't expect any actions, probably but a bit more from the Bank of England in terms of guidance. When is the time ripe to lower interest rates going forward?
Super. Thank you so much for making the time to join us this morning, David. Much appreciated.
I thank you, Bernadette.
Okay, so now it's time to take a look at technicals. Welcome to the podcast, Mensur.
Good morning, Bernadette.
So we saw it already with Jan. The risk-off mood in markets started on Thursday with gold and silver. But what's changed since then? Why don't we start with the equity market?
Well, in the equity market, not much has changed actually, but worthwhile to report the general returns for the sector. So there is a good tendency for January leaders and laggers to resume the trend. So when we look at the US, basically we see oil and gas sector and materials doing the best. So both up 14 and 8%. And the laggards are basically information technology down minus 1.6 and financials 2.6. So we still think basically that we still have the same trends of last year in general. So there is a peak of US dollar assets, first of all. And secondly, most likely there is a peak of the Magnificent Seven. So here, basically nothing has changed. And of course, the focus is here on the volatility on the gold and silver market.
All right, then. So moving to the center of that correction, then, where do the corrections in gold and silver leave the technical picture?
Yes, it's very interesting. So we might describe this as a crash, which didn't change the trend. So even with these steep declines in gold and silver within 3 days, when we look at the charts, basically, gold and silver, both markets are still trading well above their 200-day moving average. And our read, basically, of this correction is that it's a short-term consolidation. It removes excessive short-term optimism and most likely leads to liquidation of most of the investors who are most leveraged. Nevertheless, after silver gaining, being up 9 consecutive months and gold being up 7 consecutive months, we think it's a well-deserved short-term consolidation. Nevertheless, we do not have any evidence as of now that this is a start of a bear market.
Okay, good to hear. And as Jan mentioned, the US dollar saw a reversal as well last week. So has the trend there changed?
Yes, when we look at the chart, basically the dollar reversed from multi-month lows. Nevertheless, when we look at the rebound remains quite weak. And we think this is only a temporary rebound. So we are still here in the view or in the cap expecting a lower US dollar. We think this is a short-term consolidation. And we would recommend investors to remain short the US dollar for the time being.
Okay, very clear message there. Interesting. Thank you very much for joining the podcast today and bringing us some food for thought at the beginning of the week, Mensur.
Happy to be here. Thank you, Bernadette.
Well, that brings us to the end of today's show. Thank you again to my guests. I will be back again with more guests to keep you up to speed on what's moving markets tomorrow. So please do come back and join me then. Meanwhile, good luck today and in the week ahead, and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.